Futures Trading Commission's meeting is how to oversee the over-the-counter derivatives market.
Financial derivatives dictate the economy. They move trillions of dollars every year. But what's a derivative? In this video we're going to see what is a financial derivative, some common derivative types and the ways to use them. Before saying what derivative is, we first should know what real and financial assets are. But lucky you already know what a real asset is. A building, a coffee, gold, anything you can touch and buy basically. Financial assets, on the other hand, is a right. The right of owning a company or the right of getting paid in the future, so it's also an obligation to the other party involved. A financial derivative is a type of financial asset. It's a contract tied to the price of something else, where usually no side has to pay anything at the beginning. Wait, huh? Let's land this idea a little bit. Imagine you love coffee and know everything about it, like the ideal temperature and humidity for it to grow. Maybe you're on it like myself, and when you call your favorite shop, they say that this is being a tough year because it isn't raining much in Colombia and Brazil. You know, the coffee places. This will likely harm production, but people still love their coffee, so the prices may start to rise. How can you take advantage of this? Well, you could buy a bunch of coffee, say $1,000 worth of coffee, that's like 300 pounds in weight, and store it to resell it at a higher price later next year. Or you could do the following. You could contact a coffee supplier and make a contract with them to fix the price. Since you've already watched my video about interest rates, you already know that $1,000 of coffee today is $1,050 next year with a 5% interest rate for those same 300 pounds. So that's what you both agree for the price next year. This way, you have paid $0 today, and if the price next year is $2,000 for 300 pounds, you buy them for only $1,050 and sell them immediately for a profit. However, if the price drops, you'll still have to buy them for $1,050 and you'll lose money, so you're basically placing a bet on the future price. Congratulations, you've just discovered a futures contract. This is one of the most common types of financial derivatives, and there are records of the old Egyptians using them 4,000 years ago. The most common type of derivatives, besides futures, are options. They allow the buyer to have the right to buy something in the future. But unlike a futures derivative, they don't force the buyer to get it if they don't want to. So that's why they're called options. This sounds so much better to buy than a future, because if the price of the asset they are tied to, called the underlying by the way, is lower than the price you fix, you would just walk out and not look back, right? Well, there's a little catch. Options cost money, so the buyer pays a fee to the seller at the beginning. But are derivatives only useful to place bets? Is this just a casino? Well, not really. Derivatives have three use cases: hedging, speculation, and arbitrage. Hedging is just a fancy word for limiting your losses. If an American company signs a contract to deliver products in Japan and they'll take payment in yen in 3 months, they might get a futures contract to fix the dollar-yen rate and forget about possible fluctuations. This way, they will neither lose money if it goes down, nor gain money if it goes up. They might also expect the rate to go up and buy an option to buy dollars to only cover the downside. Speculation is exactly what you might expect: placing a bet. Using derivatives to speculate allows speculators to get leverage, or in other words, bet more money than they have. If the bet is right, they can earn more money than without using derivatives, but if the bet fails, they can lose much more money than they would otherwise. Finally, arbitrage just means buying low and selling high at the same time. Arbitrageurs take advantage of mispricings to make money. This can be done looking at different markets selling the same things, or calculating what derivatives should cost based on the underlying. Derivatives play a huge role in modern finance. Their misuse have caused some trouble, like the 2008 crisis, and they've been highly regulated since. When used properly though, they're an incredible tool to lower risk and increase market efficiency. But I think all of this is a different story. Let me know if you want to hear more about it, but for now, I'll see you in the next video.